Hello everyone and welcome to this explainer. Today we're putting on our sell-side equity analyst hats to conduct a really rigorous fundamental valuation and financial diagnostic of Herc Holdings, trading under the ticker HRI. We're going to strictly evaluate their current financial metrics to figure out if the market's pricing actually aligns with the company's intrinsic reality. We're talking absolute models, relative multiples, and of course the hard cash flows. So get ready for a pretty fascinating deep dive into a stock that presents some incredibly complex challenges for valuation modeling. Let's get right into it.
Okay, here is our roadmap for today's analysis. We'll hit the market snapshot, the profitability paradox, debt health, dividend profile, valuation multiples, and wrap up with a final profile.
Section 1. Herc Holdings by the numbers.
Stepping right into the market context here. Look, before we even try to build out a discounted cash flow or relative valuation model, we absolutely have to understand the environment we're analyzing. HRI recently closed at $133.60, which gives it roughly a $4.4 billion market cap. But honestly, the volatility is the real story here. We're dealing with an asset experiencing some extreme, almost bipolar market action. You've got this massive recent 30-day spike of 31.6%, right? But that is completely overshadowed by a 10-year total return collapse of negative 92.64%. For any fundamental analyst, this immediately tells us we're looking at a highly unpredictable asset. It's got a history of profound, long-term value destruction, even with these massive short-term rallies thrown in the mix.
And when we map out these yearly returns, well, the historical instability becomes even clearer. In 2018, the stock lost over half its value, down 58%. Then, fast forward to 2021, and it rocketed up 136%. We saw another strong year in 2024, up 29%, but right now, year-to-date in 2026, it's down almost 10% again. It's basically a roller coaster. This erratic timeline means that standard growth assumptions for any absolute valuation model are going to carry a massive risk premium.
Moving on to Section 2, the profitability paradox.
In fundamental analysis, we generally expect revenues to flow smoothly down to the bottom line. But this visual right here brilliantly illustrates a severe structural disconnect for Herc Holdings. On the top line, the company is growing at a highly impressive clip. The 5-year compound annual growth rate, or CAGR, for revenue is nearly 20%. That's fantastic. But then, look at the bottom line. The 5-year net income CAGR is collapsing at negative 57.66%. So sales are expanding rapidly, but profitability is literally disintegrating.
To put a really fine point on how severe this margin compression is, just consider this for a second. Over the trailing 12 months, Herc Holdings generated $4.37 billion in revenue, but their TTM net income, just $1 million. Let that sink in. That implies a razor-thin net profit margin of roughly 1.68%, which is a staggering 98% drop from its own trailing averages.
And guys, it gets even more complex when we go looking for cash. TTM free cash flow is negative $169 million. Now, as an analyst, if I'm trying to build a discounted cash flow model, negative free cash flow is a massive red flag. Without some explicitly aggressive forward assumptions about a margin turnaround, trying to derive a positive intrinsic unleveraged free cash flow from this baseline to establish a terminal value, it's functionally impossible without making entirely speculative adjustments.
All right, Section 3, debt and liquidity health.
So if a company is generating negative $169 million in free cash flow, you have to ask, how on earth are they financing nearly 20% revenue growth? To figure that out, we have to look at the debt-to-equity ratio. Just as a quick refresher, this is a vital leverage metric. It tells us the proportion of debt a company uses to finance its operations relative to the capital provided by shareholders. High leverage can amplify returns, sure, but in the face of collapsing net income, it absolutely amplifies existential risk.
What's truly fascinating here is this tale of two timelines. On one hand, HRI has a staggering long-term debt-to-equity ratio of 4.18. That is up over 47% from its 5-year average. They're highly levered. Now, given this rapidly changing capital structure, your traditional WACC estimates become highly volatile. Honestly, an adjusted present value or APV model would be more appropriate here to separate the base operations from the tax shields of that debt. But even an APV model would be heavily stressed by a debt burden of this size. On the other hand, their current ratio, which measures short-term liquidity over the next 12 months, is 1.31. So mathematically, they have enough short-term assets to cover short-term liabilities, but man, that long-term debt burden hanging over a negative cash flow operation is immense.
Section 4, analyzing the dividend.
For value investors, applying a dividend discount model, or DDM, is a super popular way to value a stock.
But remember, a DDM relies entirely on the premise that the dividend is fundamentally sound and sustainable. Herc Holdings currently pays a dividend yield of 2.10%. On the surface, looks like a totally standard moderate yield. But given that $1 million net income and the deeply negative free cash flow we just uncovered, we really have to ask, is this yield actually sustainable?
To answer that, we turn to the free cash flow payout ratio. This tells us exactly what percentage of actual cash generated by the business is being handed back to shareholders. If you see anything over 100%, it means the company is paying out cash it didn't generate from its core operations, which means they are likely borrowing money or selling off assets just to fund that dividend.
And the data here is glaring. While HRI loves to tout their 5 consecutive yearly dividend increases, their payout ratio is currently pinned right at 100%. Even worse, their free cash flow payout ratio is 100% right now, and over the last 5 years, it has averaged 120.96%. They are consistently paying out more cash than they produce. As an analyst, I have to point out that applying a standard multi-stage dividend discount model here is just fundamentally flawed. The underlying payout structure is mathematically unsustainable without relying on outside financing.
Let's look at Section 5, Valuation Multiples.
So, because absolute models like DCF and DDM are throwing off major structural red flags due to the negative cash flows and unsustainable payouts, we have to pivot. And since we don't have distinct reportable segment data to run a sum of the parts valuation, we must lean on relative valuation models to see how the broader market is actually pricing this risk. We're going to benchmark HRI against its own historical valuation here. Currently, the enterprise value to EBITDA ratio sits at 7.16, which is elevated compared to its 3-year average of 6.46. The price-to-book ratio is 2.28, slightly below historicals, and price-to-sales is 1.02. Essentially, the market is pricing HRI somewhat consistently with its historical top-line performance, and they're basically ignoring the bottom-line deterioration.
And nowhere is that market optimism more incredibly apparent than right here. The trailing 12-month price-to-earnings ratio is an abysmal negative 703, mostly due to that near-zero net income we talked about. Yet, the forward PE ratio sits at a really modest 13.37. This is a massive swing. It signals that analysts and the market are modeling a huge, rapid earnings recovery in the near future. They are betting heavily that this whole profitability paradox is going to resolve itself favorably.
But if we anchor back to the current earnings reality provided in our metrics, the fair value price based on EPS comes in at just $93.75. With the stock currently trading way up at $133.60, this implies a negative margin of safety of 42.5%. So in absolute terms, based on what the company is actually earning today, the stock appears heavily overvalued.
And that brings us to Section 6, Final Investment Profile.
So, pulling all this together, the crucial takeaway from our diagnostic is this. Herc Holdings presents a very high-risk profile for fundamental investors. We have a company generating nearly 20% revenue growth, sure, but it comes with a collapsing bottom line and deeply negative free cash flow. They're managing all this through high leverage, sporting a debt-to-equity ratio over 4, and despite all of that, they maintain an overextended dividend payout that exceeds their cash generation, all while the stock trades at a negative 42% margin of safety relative to its EPS fair value.
Which leaves us with the ultimate question. With negative cash flow, a debt-heavy balance sheet, and a functionally unsustainable dividend structure, is HRI's top-line revenue growth alone truly enough to justify its massive premium over its fair intrinsic value? Look, the market is clearly betting on a turnaround right now, but the fundamental data we've modeled out today suggests a very precarious high-wire act. Thank you so much for joining me on this explainer. Keep these metrics in mind, stay objective, and never stop digging into the fundamentals.